Welcome to the Off Street podcast featuring Adam Reiner and Sean Dan. Off Street contains general information that is not suitable for everyone and contains certain forward-looking statements of future possibilities that, due to known and unknown risks and other uncertainties and factors, may differ materially from actual results. As such, there is no guarantee that any views and opinions expressed herein will come to pass. Off Street is presented for informational purposes, and nothing contained herein should be construed as a solicitation to buy or sell any security or as an offer to provide investment, tax, or legal advice. Additionally, this communication contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to their accuracy or completeness. Adam and Sean are employees of Marshall Financial Group, Inc., a registered investment advisor. For additional information about the firm, including its services and fees, send for the firm's disclosure brochure or visit advisorinfo.sec.gov.
All right, Sean. May 2nd, 1:45 in the afternoon. We did it again.
What did we do?
We used jargon.
Yeah, real bad this time.
I'd say within minutes of episode 3, we were informed. We used jargon.
Multiple sources came from all angles.
Yeah.
Yeah, I don't know what the answer is. I don't know if there needs to be a punishment of some kind to us, like we need to feel the pain of it, or something needs to change because we're bad at this. Yes. 4 episodes in.
But just to clarify, CAGR is not a college party. It is CAGR, compound annual growth rate. We'll try to do better.
Yes.
We'll be like the old Andy Reid quotes. We have to do a better job.
We have to do. It's that simple.
It's that simple. Speaking of Philly sports, how about those Sixers last night?
You love to see that. That's the definition of stealing a win. Can't draw it up better. Best player's out. Second best player goes off for 45. And the opposing team decides not to play a lick of defense the entire game. Recipe for a win. Phillies
have Harper coming back. Good things happening right now.
The emotional roller coaster of Philly sports, it's really a day-by-day, week-by-week adventure. I feel like 6 days ago we were talking, the Phillies were on a losing streak. They looked terrible. We thought Embiid was going to be out this whole series.
Yeah.
The Eagles, it was pre-draft. Morale was low. Now all three are on the upswing.
I don't even know if it's day by day. It may be minute by minute.
Minute by minute, yeah.
Like,
waiting on
just
the
think
on
of the first
tweet.
Quarter last night. Harden steps on someone's ankle. He falls to the court. You're like, oh no, tell me he's hurt too. Ends up going off for 45.
Hey, wouldn't have it any different.
Big economic data week this week.
Mm-hmm.
Fed decision tomorrow. Some jobs data comes out on Friday. There was some jobs stuff that came out this morning that, depending on perspective, was either good or bad. Started to show some signs that labor market tightness is easing a bit.
Mm-hmm.
So we'll see what the Fed does tomorrow.
We also, just to check back in from last week, we got that postmortem for SVB that we had referenced. I'd say kind of no big surprises there.
No big surprises.
Fed mostly claimed idiosyncratic risk, poor management at Silicon Valley Bank, but acknowledged maybe some more requirements need to go in place, and they'll take a look at possibly implementing that.
Yeah. So right now, feels like we're in a bit of the calm before some of those major news stories hit. You had brought this up earlier this week. Do you want to touch on the S&P level, or do you want me to do it?
So I came across a tweet this weekend, and it was someone mentioning we started hiking, and at that point, the S&P 500 closed at 4173. That was the day before the first hike. Tomorrow, we're expected to, what could be the final hike in this cycle, get us up above 5% on Fed funds. And as of yesterday's close, we were at 4167. So for all the drama, all the volatility, 20% drawdowns last year, we're 6 S&P points away from where we started this whole cycle.
Yeah, if you go just based on a 1 year, so end of April of last year through yesterday's close, it's actually positive, a positive 1 year return on the S&P, which is kind of surprising.
Yeah, everyone last year, you're getting bashed over the head with the bad news. Market's down 2% today, 5% for the month. This year, we've popped pretty nicely. Really, since October, we've popped pretty nicely, and the mood is still, I would say, not great.
At one point in October, it was mid-October, I believe, the S&P was down 25%. Bonds were down like 15, 17%. Growth stocks were down over 30%. So who would have thought we'd be here right now?
Not me. Not me. But at the same time, isn't that the secret? Like the well-known secret of the market is this always happens. This is just how it works. the market goes down, some event or shock causes it. It looks like it's never going to end. You think the market's going to drop another 20% when it's really at its bottom, and then it comes back. Sometimes the narrative doesn't match what's actually happening. And then by the time you realize, hey, maybe we're back in this upswing, if you got scared, you miss a lot of the pop.
It's the way it historically goes. Like yesterday, I had messaged you that snippet from Bloomberg where the person that they were quoting said, recession likely in 2024. I said, I guess we're just going to keep delaying this until it happens. Last year it was maybe back half, felt like some people were saying end of 22, then the first half of 23, and now then it's shifted to the back half of 23. Now we're on the 2024.
I was about to say, I'm old enough to remember when we were supposed to get a recession in Q4 2022. Again, something we always do. And I slacked you back and I was, while we're just throwing dates around, should we try and guess at the recession after this recession? Like we've said in the past, there's always stuff to worry about. There's always going to be a recession on the horizon, whether there is one or not. Not to say there's not the possibility or strong chance of one in the near future, but it's just part of the game. Got to choose what to listen to and what to ignore.
I think that's just part of investing. There's going to be good times and bad times. So we have PCE came out last week.
Mm-hmm.
So let's update some of these inflation stories that people have talked a lot about. I'll start with eggs. Everyone's favorite inflation point at the beginning of this year, it seemed, end of last year. Well, you may be surprised to learn that egg prices have fallen, wholesale egg prices. There was an article from CNBC last week that shows that egg prices are down to $1.22 a dozen on wholesale, down from $5.46 in December. But I guess bird flu wasn't as bad at some of these farms. I looked it up on Bloomberg here this morning, and as of the 28th from the USDA, large egg prices, they say the barometer to use is Midwest egg prices, was actually below $1, 68 cents a dozen, prices paid to producers, and prices paid to stores was 101 a dozen. So this article said you could see retailers advertise eggs at a loss to get customers back into the store.
Who would have thought grocery stores would take a loss on eggs, use that as a loss leader to get people back in the aisles? I do remember a lot was made of when egg prices skyrocketed. As these things normally go with inflation, you see it a lot in the news on the way up. You don't always see it on the way down. I remember it popping. I'd say it's one of those things that when I was shopping for it, I wasn't very price sensitive.
I could see how if you were very egg dependent, if you were a bakery, maybe.
There you go. Yeah, obviously, yeah. If it's an input for you or your business, definitely changes the calculus there.
There were some funny articles that came out at the end of last year. Some good headlines.
Oh yeah, anytime. I feel like that's a financial writer's dream when like a very obscure but pretty ubiquitous item has an inflation spike out of nowhere. They love it. People have a field day with that stuff. Eggs is like the perfect. You have eggs. There's like corn futures sometimes will pop, wheat futures. People love that stuff.
Yeah.
But yeah, again, positive sign of inflation coming back down. I don't know what eggs contribute to the overall CPI. Maybe like
probably fairly small.
But hey, negative contribution. Never going to argue against that. What about I guess keeping with inflation? Did you see this Wall Street Journal article about car dealer markups did drive a lot of the inflation in the car market last year?
Well, that depends who you ask, Sean.
That does depend who you ask.
The spokesman for the National Automobile Dealers Association said it is absurd to argue that dealers contributed substantially or even at all to inflation.
Yeah, I mean, I would then show him this data saying, well, PPI, the producer's price index for car dealers, which basically is like the car dealer inflation number, went up. I think here it says since 2019, it's up in kind of the 7 to 8% range, whereas the consumer price index, the consumer inflation for new vehicles, is up 20% from 2019. So a pretty big spread there that needs to be explained away.
Funny, I looked up new car inflation, CPI, in Y charts, and the 3-year seasonally adjusted increase was 21.8%. Since 2000, that component of CPI is only up 25.6%.
Yeah, it's crazy. It's tough because we kind of knew this was happening, right? Like it wasn't a secret. Now this data point comes out from I think it's the Kansas City Fed to prove it. We kind of knew it was happening, but people really had no choice but to deal with it. It's like kind of how the housing situation right now. If you need a house, you have to deal with what's out there. If you needed a car, you're kind of at the mercy of car dealers. But it is a bummer to like read back and all this time that car dealers were throwing up their hands and being like, hey, we have no choice here. Our hands are tied just as much as yours, when really, I think their margins went from 4.9% in 2019 to 11.5% in 2022. So really pretty much everything and more was passed on to the consumer.
I just pulled up GM really quick just to see their annual revenue. In 2015, it was 135.7 billion. By 2019, end of 2019, it was 137.2. And then end of last year was 156.
No matter which way you slice it, the consumer paid, which shouldn't be unexpected, but the fact that they expanded their margins that much is tough.
I think it continues to show, though. It feels pretty confident that inflation probably peaked last summer.
Yeah.
That's what we're seeing.
Yeah. In car prices, much like home prices, still elevated. Inventory is still very low compared to what it's been historically, but starting to trend in the right direction. Hopefully the worst pain that we felt in that market's behind us.
Yeah, I thought this one was interesting, that more young adults are living paycheck to paycheck in the US. So more Gen Zers reported through this survey by Lending Club that they are living paycheck to paycheck, higher than almost every other generation except millennials. 73% millennials say they live paycheck to paycheck. 65% of Gen Z saying they live paycheck to paycheck. Boomers and seniors, about 50%. But I thought it was interesting in here that they even point out that living the paycheck to paycheck doesn't automatically imply financial hardship. I think that was like the key takeaway from the survey.
That was exactly what I was going to ask you. Is I don't think this means everyone's struggling. Do you?
No, even when they break it out by category in here, one of the questions they asked was, do you earn enough money to cover basic bills? And only 6.3% of them gave that as a reason, which was fairly low considering some of the other responses.
Yeah. In that same chart, they're asked, are non-essential spending items a reason that you live paycheck to paycheck? In Gen Z, more than 31% of people said yes, which I wouldn't call that paycheck to paycheck. When I think paycheck to paycheck, I think, like you just said, are you struggling to pay your basic bills and just, live? If you're paycheck to paycheck because you're like going to concerts and taking trips and stuff, I wouldn't call that paycheck to paycheck. That's just a decision you're making about your excess income spending.
I'd call that discretionary spending.
Like there was something I saw
basic bills.
Saw something the other day. I think it was from CNBC. It was one of those videos of, let's look at an average American family and see how they spend. And it was a guy who's talking about he was living paycheck to paycheck, and they went through his budget. He talked about in his budget, he was almost maxing out his 401k every month, doing all these things. And I was like, if you're able to almost max out your 401k, you are saving. You're not living paycheck to paycheck. You have excess income that you're putting responsibly away. So I don't know. I think there's probably a little bit of like massaging a headline here for sure.
I thought it was interesting though that Gen Z, 29% of people said that they're paying expenses for other family members.
Yeah, that was interesting.
Yeah, just keeping in mind that Gen Z is what, people younger than 25, Sean?
Yes, 26. I think it's ages 11 to 26. But they also quote for Gen Z, they're more likely to spend on dining and entertainment even while struggling to cover everyday expenses, which again, looking at the table, it seems like while there are certainly people struggling and having a tough time, a vast majority are willingly spending on those non-essential spends, which is not a bad thing, I don't think, especially if you're at a young age. I know people try and talk about kind of that smoothed income approach. Like I'm going to spend a little more percentage of my income when I'm young to still get the enjoyment and then try and save more in my 40s, 50s. I mean, it's probably not a bad thing when you're young and you take advantage of those experiences as long as you have a plan long-term.
That's one of the spending habits that COVID changed, and that for a long time, it was about deferral. Save today so you can live this lifestyle later, or retire early, or just retire in general. Then it felt like COVID happened and people adopted the mindset that I'm not sure what's going to happen tomorrow. I have to find some better balance between enjoying the moment and also thinking about tomorrow. Maybe Gen Z's doing. Did you see they're buying homes?
I did. I've more pushback on this article. This is the Redfin article you're talking about.
So this was by Redfin, and they are reporting that Gen Zers born 1997 to 2012, for this analysis, they only counted Gen Zers 19 through 25. And they found that Gen Z home ownership rates are nearly 1/3, 30%, which is slightly higher than home ownership rates for millennials, which was 28%, Gen Xers, which was 27%, but slightly below baby boomers, 32%, when they were 25 years old. Pretty surprising.
I have such a hard time believing it. Like, because that's my kind of age demo, like mid-20s. I know so few people that own homes. And maybe it's just because I've been growing up in the Northeast, knowing a lot of people now that live in cities. Maybe in different parts of the country, it's more natural to you graduate college or you graduate high school and start working and buy a house. But like they say 30% of 25-year-olds own their own home in 2022. It's just that's kind of hard for me to wrap my mind around.
Said part of it was young adult kind of rode the tide of low mortgage rates and strong job demand during the pandemic. But just to even think through that, 25, you had just been graduating college when that was happening. Everything had to line up right. You had to have a job, income history, buy a home.
Yeah, which maybe, I guess, if you are at the very high, like the oldest end of that range, and say you graduated in 2020, got a little bit of money for a down payment, had a good job, and if you could have bought in that range before housing prices spiked and mortgage rates were low, maybe you did get a great deal. But maybe it's also that I'm just getting jaded by today's climate. It feels really hard for anyone to buy a house, let alone someone in their early 20s with a low asset base.
Yeah, I thought it was interesting that they had quoted income. 25-year-olds, median monthly mortgage payment was a little over $1,000. This is as of 2021. So we know rates have gone up since then. So mortgage payments mostly have gone up as well. And their median income was about $75,000. Compared in 1990, adjusted for inflation, it was $69,000. I don't know. It could just be the sample size of people that are buying homes are doing financially better than those that aren't.
Yeah, because I would think 74 feels incredibly high for a median income for
Someone under
25-year-olds.
Yeah.
Isn't that above like the median for an average U.S. adult? Like
Yes.
let alone being early career. So that feels high. They did mention in the article too, they talked about how millennials are kind of in this fractured. I want to get your opinion here. Millennials are even being in that same age bracket, you could be feeling a lot of different things depending on exactly when you were born and exactly when you bought your house. They talked about how older millennials entered the workforce in the wake of the dot-com bubble. They probably were looking at like family formation, home formation around the time that the great financial crisis hit. And they were in a demographic that was popular for layoffs in the 2020 COVID pandemic. Obviously, that was kind of short-lived. There were some millennials who kind of had some bad strokes of luck in there. And then on top of that, if you were looking to buy a house in the past couple of years and you missed that 2021 window, now you're in a brutal spot of trying to look for a house. Whereas if you were a millennial who maybe bought in 2020 or 2021, it's a pretty fractured environment, even within that millennial situation. Thought that was like an interesting thing to point out.
Yeah, they talk about it in here that home ownership rates for 40-year-olds, so millennials, are below that of the other generations, behind baby boomers, behind Gen Xers, for the same point in their life. And it probably has something to do with what we're talking about.
I ran it real quickly. If you were looking at, just to make the numbers round, if you're looking at a home in 2021, say a $500,000 mortgage, when mortgage rates were at 2.75%, the principal and interest on that was $2,041. If you missed it, and now housing prices are up roughly 30%, mortgage rates spiked to 7%, you add 30% on there, so $650,000 mortgage at 7%, it more than doubles the principal and interest, $4,300 on that. So, like, and what do you do? Because you got to think, obviously, inventory is low. They said people ages 25 to 44 dominated home purchases the past 1 to 2 years. Like, you got to assume those people aren't leaving if they have low mortgage rates. If you're an older person who has your house paid off, you're probably not leaving either. Housing starts are down. Housing construction's down really since post-global financial crisis. Like, what do you do? If you're a first-time home buyer, if you're someone who has to move, are you just in a really tough spot? You just got to grit your teeth and bear it?
I think if you have to move, you really have to move. I think you're just in one of those tough spots and you do it and you hope rates come down and you can refinance at a lower rate. Lower your mortgage payment that way.
Yeah. I mean, on top of that, remote work makes it easier to live anywhere. So like another reason people might not move where they did before.
Yeah. It's funny. It seems like every day though, we're seeing more and more headlines of large companies trying to get people back to the office.
Yeah.
I'll be interested to see how successful they are in doing that. But it was interesting to see where people are buying houses. Those under 25, which still make up a fairly small share of new home purchases. The two most popular metro areas, Virginia Beach and Cincinnati, Ohio, where there are low median sale prices. It said the median sale price of Gen Z purchases was $235,000. And then they had in here 25 to 34-year-olds, much larger share of home purchases, about 40%. Seattle, Washington, and Philadelphia.
There you go. No, definitely more, I'd say comparing the two lists, that could be another thing too. Under 25, I'd say secondary, tertiary locations.
Yeah.
Whereas the 25 to 34-year-olds, it's more like A-list cities, like the most desirable cities, I'd say. A lot of, not to say Philadelphia, Philadelphia's probably lower on that list, but like Seattle, Austin, Denver.
So I'm curious, since you had asked the question, what do you think it would take for you to stop renting and buy a home?
Well, I think for right now, I'm pretty comfortable renting because the spread between renting and owning is so far out of whack right now. It is so much more expensive to own a home. There's a chart from Goldman Sachs that pointed out kind of that spread. So I don't feel like I'm necessarily getting a bad deal by renting. I think it would need to be really even more than a correction in prices is a correction in rates. If something great popped on the market, maybe I'd look at it. But until rates normalize a little bit, I'm not chomping at the bit.
I know earlier you had said, or I asked about millennials, that there was the dot-com bubble, the recession, COVID. I don't know. You can probably make the same argument for other generations as well, that there were these like life events that happened, should have impacted home ownership on some level. Even, or would this be baby boomers or Gen X? Vietnam, oil embargo, high inflation.
And not to like, I don't have the exact stats to back it up, so maybe dangerous to talk about, but like the home price landscape was different back then. Is that incorrect? Like home prices on a relative basis, even fixing for inflation, were much cheaper and much more easily attainable than it is now. Correct? Maybe that's just a wrong like prior that I hold, but I don't know. I have
It
that
would
in
be
my mind for
interesting to
some reason.
see, like, look up median household income versus median home sale price
Yeah.
and see what the percentage is.
I believe I did that at some point, and the CAGR for homes was higher, but not
You said
remarkably.
it.
But again,
You said it.
yeah. Well, we defined it, so I can say it now, right? You want to move on? Anything more on home ownership, or do you want to do some uncorrelated?
Let's do it. So Colombia, Sean, the stories from the Wall Street Journal, known for their exports of petroleum and coffee, according to the World Bank anyway. Year-over-year inflation of 13%. They're getting into the hippo exporting business.
Yes, not by their own volition, as a matter of necessity.
No, as the article says, the giant beasts that are originally from Africa have spread across 120 miles of Colombian waterways, and they're trying to find a way to control the population. The hippos, of course, come from Pablo Escobar, who imported them 43 years ago for his private zoo. And then after his death in 93, they broke out and spread. So now they need to find a way to control these hippos that they have in the country now.
At first, they thought about trying to castrate the hippos. That's a very expensive and tedious process. So then someone else came along.
$17,000 to do that. Yes.
And they said it takes 5 hours, and you kind of have to do it in the wild, like in the sun. So not ideal for the number of hippos they have to go through.
And 180 pounds of carrots to help lure the hippo in.
So a private animal sanctuary in Mexico has reached out to try and help them. And their proposal is to start flying the hippos out either to a sanctuary in Mexico. And they believe they can do 15 to 20 at a time in a single aircraft. But the transfer price will be about $5 million for the cages and airfare. They said up to this point, 2 people have been killed by the hippos. But they said as the hippo population grows, as they become more popular in neighborhoods and stuff, that could skyrocket. And it sounds like they're surprised it isn't a higher number already. So definitely a big kind of headache and danger.
As I said, at night, they'll just walk through neighborhoods like stray dogs.
Do you see the person who took one in and was raising it? Was feeding it infant formula and raising it like it was a big dog.
It's
kind of
crazy.
Cool. I mean, until they get too big.
Get too big. Let's talk about the champagne of beer, Sean.
The champagne of beers. It's a lot of debate. Of the big 3, Miller Lite, Bud Light, Coors Light. Do you have a preference?
I personally prefer Miller Lite. Do you have a preference since you asked?
I'm a Coors Light fan. Blues the Rockies.
So how you look at the mountains to know if the can's cold?
Yeah, when the can is cold, the mountains turn blue. Innovation that excites.
So Molson Coors, the owner of Miller, is the world's 5th largest brewer, $10.7 billion of revenue at the end of 2022. There's a lot of brands under their label. You'd probably be surprised by some of them. Notre Dame favorite, I believe, Hams is.
Yes, of the land of sky blue waters, Hams.
that falls under Molson Coors. They had 2,300 cans of Miller High Life confiscated by, I guess, by Belgian customs at an airport on their way to Germany. They contacted a trade organization that oversees what can and cannot call itself champagne. They reported the beer to them, and the trade organization requested the destruction of these illicit goods. They contacted the person that was trying to import the beer into Germany. They didn't fight the destruction of these 2,300 cans of Miller High Life. Kind of interesting to see the process they went through to destroy these cans.
Everything about this story is ridiculous. The fact that Europe has such a strong, I don't know, what would you call it, regulations around what can and can't call itself champagne. The fact that
one I get. You can't have everything calling itself champagne. Only sparkling wines from France's Champagne region can be champagne.
the fact that the regulations were so strict, and if anything, like Molson Coors was very apologetic. They were almost embarrassed that Miller High Life had tried to come into Europe and hijack the champagne name. They said they didn't know why it was over there and how it got there, and they were fine with it being destroyed. They were apologetic, if anything.
Yes, they said they hope they invite their friends from Europe to the U.S. anytime to toast the High Life together.
Yeah. So, it makes you wonder how powerful, I guess you don't want to make enemies of the champagne brand in Europe. Power player.
Strong trade organization. But they had a video on the Associated Press website of the destruction of these 2,300 cans.
Yeah.
And there were, I guess, 3 customs officials that had to open each can one by one, flip it upside down to dump it out. And then all the cans looked like they got put into some type of system to crush them.
Like a hydraulic press type thing.
Yeah. All these cans. But
I don't know. And the fact that they got the press there to videotape this whole ordeal, very funny. Very funny to me.
You cannot have a beer call itself a champagne.
Not in France. They're not going to allow that.
Parting thoughts, Sean?
Interested to see what Jay has to say tomorrow. Jay Powell at the Fed meeting. What I think will happen, the market will read in very far into whatever he says. I hope they don't. I hope take it at face value. Their formula is not going to change, but 25 basis points, hopefully benign comments. We just keep chugging along, see what happens by June.
That's the thing. It feels like it's going to be the comments that everyone's looking for a clue of what's going to happen.
Just nothing new, right?
Are they going to hit? Not anything new. Are they going to pause? Is there another rate in there? Is there any change in language? We're going to do that whole post-release analysis and all that again, parsing through every word.
Like, what about I don't know what the term is. Like, there has to be some sort of behavioral fallacy here, because when we're hiking 75 basis points at a time, kind of knew what the comments were going to be, kind of knew we're hiking 75. We took it in stride. Now we're like threading the needle at the end of 500 plus basis points of hiking. We have 1, maybe 2, 25 basis points hike left, and people are starting to get uneasy again.
It's kind of interesting, though. It was only a week prior to the last meeting where Silicon Valley Bank failed. Then last week, I guess really this weekend, First Republic Bank failed.
Yeah.
I wonder if that plays into their thinking this time. It seemed like the Silicon Valley Bank failure really impacted their decision-making in March. I don't know if First Republic will play quite the same way, but it seems like bank stress is still there at some level.
But we'll see. I'm sure it'll give us something to talk about next week.
I have a feeling we're going to be talking about, I'm not sure. I would suspect people are going to try to determine, is it a hawkish pause? Is it a dovish pause? Is it just a pause? So we'll get to play that game.
It's never just a pause, Adam. It's never just a pause. If you think it's just a pause, you're not reading deep enough into every word he says.
And I imagine he's going to get asked quite a bit about debt ceiling tomorrow as well. Powell, him being Powell during his press conference. Congress has asked him a lot about it over the past 6 months, 3 months, and he's tried to avoid the question as best as he can. I don't know if we're in the calm right now. We'll see what happens next week when we record.
Sounds good.
All right. See you next week.
See you.